The Fed's balance sheet is exploding. Why on earth is the dollar going up and gold going down? I'm going to explain that to you in 3 simple, fast steps. Step number 1, let's talk about gold. But before we do, I want to address the news that I saw this morning, and that's that the Fed is starting $125 billion of QE per day. Per day. To put that into perspective, quantitative easing 3 was $85 billion a month. A month. And they just announced they're doing $125 billion a day. I mean, where are they getting enough treasuries to buy? And the whole problem with the repo market, or one of the main problems, is that there's not enough collateral. So they're out there taking collateral out of the system, putting it onto their balance sheet. Absolutely amazing. It's truly QE infinity. In fact, they've actually admitted it now, as though it's a good thing. They're not calling it QE infinity. They're just calling it open-ended. There is no limit to the amount of money they're going to print. Also, they came out with a statement saying they are now buying everything. There's no pretending anymore. They've extended it to student loans, credit card debt, auto loans, SBA loans, and my favorite, mortgage-backed securities, not the typical kind, but commercial real estate. I mean, look at what they're doing. They're looking at any asset class that can possibly go down, and they're taking it off the private sector balance sheet and putting it onto their balance sheet. So no matter how much of a haircut these assets take, it's not going to matter because it's on the Fed's balance sheet. Now, I shouldn't say it's not going to matter, because there's some huge ramifications to this. More on that in step number 3. Now let's get right back to gold. The first thing we have to understand is how a margin call actually works. For that, let's go straight to the internet. Easy example, if you buy $100,000 of stock on margin, you only need to pay $50,000, let's say. But what if the stock drops to $60,000, you've lost $40,000. Now you only have $10,000 in your margin account, and the rules say that you need to have 25% of the 60. So you have to deposit another $5,000, or you have to sell another $20,000 worth of shares. You just keep doing this over and over and over again if the market continually goes down until you're broke. So this is why you always hear people talking about liquidity and margin calls. When the stock market goes down, they've got to raise cash very, very quickly. A lot of times they'll do that by going into the repo market. This brings us to the chart that I've got from Jeff Snyder. Going back to 2007 and 2008. On the left-hand side, $1 trillion up to $6 trillion. The green line is the price of gold, and those prices are on the right-hand side. The blue line are the repo fails. And what the repo fails are, if you and I are doing a transaction, let's say you're JP Morgan and I'm XYZ hedge fund, and I'm borrowing money from you in the repo market, I'm giving you collateral, let's say treasuries. But 5 minutes before the transaction, one of us backs out, that would be a repo fail. And there's several reasons why this can happen, but as the market gets shakier, usually you see more and more repo fails. This would require the hedge fund that needed the liquidity to meet the margin call to have to sell something in order to generate the cash because they can't get it in the repo market. What would they sell? Something like gold. And there's 3 main cross currents that are at play: fear, liquidity, and collateral. The blue line, again, represents the collateral in the repo market. This green line represents what's happening with the price of gold in relationship to fear liquidity and collateral. So starting in early 2007, there's a lot of fear in the market due to what's happening in the housing market. So gold goes up almost in a straight line until we get to Bear Stearns. It goes bust and the collateral issues in the repo market go through the roof. I actually didn't draw this very well. The top of the blue line is quite a bit further to the right than the top of the green line. And editor, go ahead and throw up the chart so the viewer can see what I'm referring to. And that's important because the top of the repo fails were after Bear Stearns goes bust. That means that there's more liquidity needed for those hedge funds or the financial institutions, so they have to sell their gold. Therefore, the price of gold goes all the way down until more collateral hits the market in the form of the government allowing, or the Fed allowing, asset-backed securities as collateral. Once they temporarily fixed the collateral issues, fear, once again, took over as the strongest cross-current. It took the price of gold up until they banned short selling on the GSEs like Fannie and Freddie. Now, all of a sudden, there's no more fear in the market. Everyone thinks problem solved. So gold price goes down until we get to Lehman Brothers. Then fear picks up again, takes the price of gold skyrocketing up until the other two cross currents of liquidity and collateral take over the amount of fear. This makes the price of gold plummet all the way down while the market is crashing until the Fed started quantitative easing number 1. This put a band-aid over the collateral issue. Then fear took back over and the fundamentals. The market saw how much money the Fed was going to print and how much the balance sheet was going to expand. Gold goes on a bull run for the next 2 or 3 years. So if we look at the repo fails, we'll get a glimpse into what the institutional investors are doing, and it'll help us better understand not only why the price of gold is going down, but maybe more importantly, when it might go back up. So let's look at a chart, again from Jeff Snyder, of the current repo fails. You see, just going back to the week of March 4th, the repo fails spiked dramatically. So if this is a Lehman Brothers moment, we're just at the very beginning, and we'd have to look at a chart of more recent repo fails to see if it's increasing. My guess is it is, because the market, as we all know, is crashing. So when the repo fails spike and then start to go back down, most likely that's when the institutional investors will have either sold all their gold so they don't have any more to sell, or the Fed somehow temporarily solves the collateral issue once again in the dollar funding markets. And I'm by no means saying that you should base your decision on whether or not to buy gold for your portfolio on the repo market or repo fails. I'm only going over this so you get a better understanding of what affects the price of gold. Step number 2, why is the dollar going up in value? First, we've got to be clear. The dollar is going up in value against a basket of other currencies. It doesn't necessarily mean that the dollar is going up in value relative to what you buy on a daily basis. It could be going down in value for food and up in value against the yen or the euro. Also, we have to understand there's two completely separate economies for the United States dollar, a domestic economy and an international economy. As we all know, the dollar is the world reserve currency. So not only is oil denominated in dollars, meaning you have to pay for oil in dollars regardless of what country, and therefore the country that's selling you the oil is also receiving dollars. But most of the corporations outside of the United States are funded in dollars as well. So if you started a gold mine, let's say, and let's say you're a Canadian that starts a gold mine in Brazil, you would most likely borrow dollars in order to start that gold mine. So a lot of countries and entities outside of the United States borrow in dollars. This gets extreme, especially going back to 2012 through 2014 when the dollar was cheap and interest rates were zero, just like we have today. But a lot of these countries and corporations outside the US loaded up on dollar-denominated debt, even though their revenues may be in their own local currency. So what do I mean by loaded up? Let's go to some charts. This is a great chart of emerging market exposure to USD appreciation. What they mean by that is how much debt do they have in dollars that makes them susceptible to their currency losing value against the dollar. And I'll explain that a little bit more, but let's look at this chart. So Turkey had dollar-denominated debt in the amount of 13% of their GDP. As of 2017, that number was 24%. Going down to Mexico in 2008, right around 11, now 22, 23. And we can see countries like Indonesia, Saudi Arabia, Russia, South Africa, and China have a huge difference, a massive increase in the amount of dollar-denominated debt that they have relative to 2008. This chart gives us a great visual and specific numbers. Look at how it flatlines from 2000 all the way to 2003 or 4, and then just goes almost straight up to where we get to a point today where we have over $4 trillion. Keep in mind this chart's a little old, so I'm extrapolating it forward. And this is only emerging markets. So the world in total has a lot more dollar-denominated debt than you even see in this chart. And why this is a big deal? Because most of this debt was taken on when the dollar was very cheap, about 70 on the DXY. Now that it's over 100, 102 as of today when we're speaking, think about what that does to the value of that debt when your revenue to pay the debt has gone down in value. If you're a country like Colombia, as an example, or South Africa, and you have a lot of dollar-denominated debt and your currency depreciates by 20%, unless you have some form of dollar-denominated revenue, in this case maybe oil, and then to add insult to injury, the price of oil goes down. So now you have fewer dollars coming in to pay that debt. How do you make up the difference? You have to print money, but you have to print more of your currency than you would have back in 2012, 2014, because the dollar since then has appreciated. So let's just use real numbers. Let's say that back in 2012, there was 1 peso for every $1. Now there's 2 pesos to every $1. So if you had $1,000 in debt, you'd have to print 2,000 pesos now instead of 1,000 pesos back in 2012, 2014. So this creates additional supply of the XYZ country currency. More supply, price goes down. Let's also remember that because of what's going on with the cerveza sickness and the whole entire world basically going into recession, if not a depression, these countries can't increase interest rates to defend their currency. So their currency comes into this doom vortex where they can't increase interest rates because that crashes the economy. But if they don't, then that lowers the value of their currency, which makes them print more currency to satisfy the dollar-denominated debt. It really gets ugly very, very fast. I want to be clear, this doesn't just happen in countries most Americans would consider third world. This just happened in Australia, where their currency took a beating. Editor, go ahead and throw up the chart. against the United States dollar in a very short period of time. Why? Their economy is having significant problems. The only thing they can do is print money, but they can't increase interest rates. The important lesson here is the currency of other countries go up and down really based on the fundamentals of what's happening domestically, where the United States dollar is unique in the sense that it doesn't always go up or down with what's happening domestically in the US economy, but maybe even more so what's happening outside of the United States. Step number 3, can the Fed solve the problem? Of course, when I mean solve, I mean put a temporary band-aid over it. There's no way they can permanently solve the problem now. It's too big. The only thing that's going to fix this is a reset of the entire system. But can they at least put a band-aid on it? Well, going back to step number 1 and the news that we talked about, they're literally buying everything now. They're buying everything in the repo market, stocks, or at least they're committing to. Buying stocks, bonds, commercial paper, mortgages, not just residential mortgage-backed securities, but also commercial real estate mortgage-backed securities. So next time you go down to your local Subway, if you're not quarantined already, or going down to get your hair cut, that strip mall could potentially be owned by the Federal Reserve, or at least the title could be on the Federal Reserve's balance sheet, or at least the debt. So then consumer debt, credit cards, student loans, small business, medium-sized business, whether it's equity or debt, it's all going onto the Fed's balance sheet. So, I mean, it's just hard to say out loud. It's so ridiculous. The important thing to remember, aside from the insanity of what the Fed is doing, before they'd work directly with the primary dealers, and I've got this highlighted by a black arrow going from the Fed to primary dealer bank A, B, or C. The reason this is important, if you guys haven't been watching my recent videos, is because a transaction like this doesn't create additional deposits in the real economy. Why? Because A, B, and C have accounts held with the Fed. So if the Fed buys an asset from the primary dealer, or the primary dealers give the Fed an asset as collateral, the asset goes onto the asset side of the Fed's balance sheet. It's either collateral, which I have in blue, or garbage collateral, which I've got in red. That would be something like a rehypothecated treasury or mortgage-backed security. Who knows what the Fed is taking and what they'll admit to. But then the Fed just creates funny money out of thin air and deposits the funny money into the reserve account with either primary dealer A, B, or C, whomever they do the transaction with. So there's no additional deposits that can be spent other than by the primary dealers themselves. What's different about today's announcement and what I predicted they would do over the last probably few months is they're going directly to all the other banks outside of their umbrella, the hedge funds, the corporations, the financial institutions, most likely the general public and the small and mid-sized businesses once they start the helicopter money, or MMT, which I think is most likely the next step. Whether the Fed does that or the Treasury from the Treasury general account, who knows, but I think it's happening. So here, what's different is you have green arrows. The difference between the black arrow and the green arrow transactions actually create more deposits because the Fed is saying, hey, listen, retail bank, or listen, hedge fund, we're going to take that $1 billion worth of credit card debt that you have as an asset on your balance sheet, consumer credit card debt, and we're going to deposit that $1 billion with your retail bank XYZ. Great. So the hedge fund's bank account goes up by $1 billion. That increases the deposits in the real economy. Then, to offset the liability, because that's a liability on the balance sheet of the retail bank, the Fed prints up more funny money and just adds that to the reserve account of the retail bank. You see the difference? It's still just printing up reserves and putting it onto its balance sheet, meaning the Fed. But in the case of the primary dealers, just to reiterate, it doesn't create an additional deposit at a retail bank. So if it creates a deposit with a retail bank, that's increasing the money supply, or more money chasing the same amount of goods and services. So if velocity stays consistent or increases, we have consumer price inflation domestically. But my point with going over this is to show you, as far as the collateral problem or the liquidity problem that could be an issue to bring the gold price down further, like we saw in 2008 with the repo fails spiking. Now I see this and what they've done today, Monday, and I say to myself, wow, maybe the repo fails are at a maximum right now. Maybe from now on they're going to go down, because how could there be a liquidity problem or a collateral problem anymore when the Fed has literally exchanged all the existing collateral for liquidity? Who knows? And I'm going to call up Jeff Snyder and see if I can book an interview with him so he can tell me where I'm wrong. But I think this could solve, and again, temporarily, the problem of liquidity and collateral, meaning fear will take over and fundamentals might take over with the gold market. We could see it going back up. Okay, moving on to the next problem, and that was with the dollar going up outside of the United States. The government is going to deficit spend like a drunken sailor. They might spend just as much money as the Fed. The difference is technically the government can't print funny money out of thin air like the Federal Reserve can. They actually have to issue debt. So they issue all these new treasuries. They can't issue that many without the interest rates going up. So the Fed has to monetize the debt by buying a lot of those treasuries. So your insolvent Uncle Sam, who is right here, drunk as usual and kind of cross-eyed and pissed off. I don't know why he's pissed. He's getting all this free money. But the treasuries go from the government, they auction them off, it goes onto the Fed's balance sheet. The Fed prints up more funny money and deposits that into the Treasury General Account. That's basically the bank account of the Treasury. To be clear, it doesn't go directly there. It takes a few different steps sometimes, but it usually ends up in the Treasury General Account. From there, all the funny money that the Fed printed is going to go into the economy because your drunk, insolvent Uncle Sam is going to spend that. So those dollars come raining down on everyone in the real economy. But let's not forget, the big problem we are talking about is dollars outside of the United States, not inside the United States. So how do dollars get outside of the U.S.? There's a lot of different ways, but the main way is for us to import more goods and services than we are exporting. That creates a trade deficit. So since we're buying more stuff from the world, the only thing we have to give them for this stuff are little green pieces of paper. So all the green pieces of paper come out of the United States, go to XYZ countries, and those imports come into the United States. That's usually how the world gets the dollars they need outside of the Eurodollar system to function. Insert the cerveza sickness. We all know global supply chains are being disrupted. That means fewer imports coming into the United States and fewer exports of dollars going out of the United States. So I think it is very possible. Nothing's a certainty at all, especially with all the unknowns. I mean, I had no idea when I woke up this morning that the Fed was going to announce to the whole world that they were doing QE infinity. I've been making fun of them, calling them Buzz Lightyear for the last 2 months, but now they just came out and admitted it. So again, my point is, who knows what's going to happen? But I could see a situation play out where the dollar outside of the United States goes up in value, while at the same time inflation on staple goods, all those things that we were importing from China, all the stuff at Walmart, Home Depot, Target, those items go up in price, and gold goes up in price as well. Very counterintuitive, I know, but we are living in some very strange times. So I'm not saying that's for sure going to happen. I am saying it's something that is probable, and we should all think about how that would work, what the ramifications could be, so we can make sure that we're financially prepared. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.